What's going on, everybody? We are 15 minutes away from the FOMC announcement today. And if you can't tell, I'm really excited about it. Are you guys really excited about it? Are we dreading it? Are we hopeful? Are we not hopeful? How are we feeling about this FOMC announcement today? I'm very curious to know all of your thoughts. You know, I had heard that maybe there was about an 80% chance of a 100 bips hike. I'm reading today, everyone's expecting a 75. What are you guys expecting? Are they going to surprise us? Are they going to disappoint us? What's the reaction going to be? I want to hear from you guys in chat. What are we thinking is going to happen today? So far, the Qs are really strong. We look at SPY. SPY's looking about the same. You can look at IWM. IWM not looking quite as strong as the other two, but big gap ups today across all of the indices. Something to be mindful of. Is this the first move? Is this the move before the announcement? I mean, I don't know. If it is, if this is the first move, you know the saying, the first move is generally wrong. Might this be the wrong move? I don't really know. We're going to find out here in about 14 minutes. Hopefully you guys are all having a good day today. Hit me up in chat. Let me know what you're thinking. Because I'm really curious to know kind of what you guys are expecting. Seems like they could play it safe today. But who knows? We don't really know. So hit me up. Let me know what you're thinking. Just kind of keeping our eye here on the indices for any clues. You know these things are going to make a big move the second things get announced. If anybody's in chat, can hook me up with like a link to the press conference. I know the press conference is half an hour after the announcement. What's up, Webworthy? How we doing? Hope you're doing well. What are you thinking for this FOMC announcement today? What's up, SDW? Thank you for being here. Abhay, what's up, brother? Hope you're doing well. You say 75 bips. That's what you think. The question is does 75 bips control the problem? If there is an inflation problem, I mean, clearly there is an inflation problem. Does 75 bips do anything to manage it? I don't know. I mean, does 100 bips do anything to manage it? You're talking about 1%. Last reading we got on inflation was 9.1, right? Yeah, exactly. SDW. Does any of it solve the problem? And then therefore, if none of it solves the problem, does any of it really matter? I don't know. I really genuinely don't know. What's up, Francisco? Thank you for being here. Jarek. What's up, man? One definitely has, 100 bips obviously has more of an effect than 75. But it's only 0.25% more. But it is faster. Maybe it's more about what the 100 bips signals versus the 75 bips. 100 bips maybe suggests something about what the Fed is thinking, whereas 75 kind of almost feels a little bit like, yeah, you just kind of expect that. Francisco, man, I appreciate the kind words. That's very nice of you to say. We do our very best here every day. So thank you for giving us a little bit of love. We do appreciate it. Do we have any non-TrendSpider users with us today? If you are not a TrendSpider user, please say hello. I would really love to chat with you. Nightbot says 1 hour, 9 minutes, 56 seconds until FOMC announcement, but Nightbot is wrong. This is coming in 10 minutes. What's up, Joel? John? 19KI Crag? David? Abhay, are none of you guys TrendSpider users? Jeff Hext, what's up, man? Caleb on his 3rd day of a free trial. That's tight. Thank you for signing up, Caleb. Do appreciate it. Are you liking the platform so far? Let's do this for everybody who is not. Ooh, this is on the wrong screen. For everybody who is not a TrendSpider user, I'm going to hook you up. Give me 1 second. And I will send you a link. I want to take care of you guys here on the live stream. Let me see if I can find the link and get my lovely producer to hook me up with it. Here it is. She's gonna hook me up. Thank you. I very much appreciate it, Miss Sadie. Everybody, say hello to Sadie. She keeps things running on the background or in the background. Here you go. For all of my non-TrendSpider users, here's a link to a discount code. This is 25% off the plan of your choice. So if you're interested in the platform, but you have not signed up for it yet, this is a good opportunity to do that. What's up, Spanish Fly? How are you? What's up, David? Ted Waldron, what's going on, man? I'm not talking about a Discord link, but that's coming, man. We're gonna be opening up a Discord here relatively soon. It may actually be open. I don't know for sure if it's actually open yet, but it's coming. Yeah, so 7-day free trials. If you're kind of like, maybe you're a TradingView user and you've seen us online, you're hearing people talk about us or whatever. 7-day free trials for anybody who's interested in giving the platform a spin. I would encourage you to at least do that. If you're curious about the platform, give it a try. 7-day free trial, and we do actually offer extensions on those trials too. You can always get an extra week or so. Joel Snyder does not trade yet. Well, props to you for spending some time on some channels that are all about trading. This is a good way to learn. Yeah, I'm kind of curious about a link to the FOMC meeting too. If anybody wants to throw a link in the chat, we can definitely watch that press conference once it airs. I believe it starts at past. Thomas Nist, what's up, man? Thank you for being here. Do very much appreciate it. Again, if you're interested in being a user, use that link that I just linked. 25% off the plan of your choice, monthly or yearly plans. Feel free to help yourself to it. Aaron Schroep, what's up, man? Do any of the features help with finding good setups for the wheel strategy, like the Power X optimizer? I don't know anything about the wheel strategy or the Power X optimizer. Why don't you tell me a little bit about that, and maybe we can figure that out for you. I will agree with you on that. The meetings are pretty much always start late. Let's see if I can do some searching here, guys. I might go quiet for like a split second. I'm gonna see if I can't find. Let's see if I can't find a link for us here. I mean, we're gonna know pretty quickly that the data is out, but let me see if I can find a link to the meeting, and that'll get us cranking here. Okay, so if you guys follow Federal Reserve on Twitter, they've got a link on. Here we go. Grab this, and like I said, as soon as this starts, I'm going to switch over to it so that we can watch it together, and we can yell at Jerome quietly from our trading desks. Here is the link to the meeting, but don't leave. Don't leave me. I need company while the meeting's going on. So the wheel strategy is basically selling puts, and if assigned, you basically sell covered calls. Interesting. Yes. So as far as let's see here. As far as, let me see. Finding good setups for the wheel strategy. So since the wheel strategy is specific to selling options, there's not a way to test on the platform for an options style strategy like that. There's plenty of ways to test there's plenty of ways that you can test on the platform using the strategy tester. That's this guy right here. You can input entry criteria, you can input exit criteria, and it's going to tell you how a stock performs over a period of time that you define. So very, very basic, very quick idea here. You know, we have a handful of pre-written setups that you can utilize, but I would imagine if you're utilizing some sort of strategy like what you're defining here, what you're talking about here, you probably have a reason why you're getting into or out of these trades. So maybe we can talk about that a little bit, and I can talk you through how to do that here. But just very, very basic, right? If your strategy is you're buying on the EMA 13 crossing up on the EMA 26, and then you're selling when the EMA 13 crosses down on the EMA 26, we're using let's say a 1.5% stop loss. We're using the 30-minute time frame here. You can test back up to 7,000 candles, and what it's going to do is it's going to run all of those trades for you, and it's going to give you an idea of how the trade performs over a period of time. So in this particular case, we can see here 109 positions across the past 2 years of data. So on the 30-minute time frame, 7,000 candles takes you back about 2 years. The performance of that strategy, 19.8% gain versus a 28% gain over the same period of time on the asset. So essentially asset performance is like the buy and hold strategy. And then this 19.8% value here, this is the strategy that we've defined, that moving average cross. On the right-hand side, you've got this tabular data readout, and there's a lot here. Kind of what I pay attention to is total amount of positions, your win-loss rate. You can see here your win rate's 36%, not super great win rate. Your max drawdown, negative 14.37%, pretty big drawdown there. Your average win is about 2.5%. Your average loss is about 1%. Your average return is about 0.19%. So this just gives you that basic breakdown of how this strategy performs. Now we could get a lot more thorough with this strategy if we wanted to. We can add parameters here, and we could use price conditions, indicator conditions, candlestick pattern conditions. And you can even do things like, I'm just going to add some other things here, just like random stuff, just so you can see me putting in criteria. All right, you could even add condition groups and change definitions of the conditions contained within your different groups. So for example, I'm just gonna say, right, so we have, actually, let me add one more thing here so we can kind of talk through how this works. And I'm literally just adding random stuff. We could get specific with it if we wanted to, but like, this says all the following. So these two things have to be true for us to get into a position. I could change the definition of these two conditions and say, these two things are true, and then either one of these is true, and that's what gets me in. And you could get even more thorough with it. So you could test back up to the monthly time frame. You could test back up to 7,000 candles on any time frame. You can only test one time frame at a time, so that's something to keep in mind. But yeah, that's kind of a breakdown of the strategy tester. That's a very roundabout way of answering your question of, can we back test and see if a particular strategy works, or a particular strategy would be good for selling puts or buying puts or scaling or whatever. All right, so we are 1 minute away from an announcement here. I'm going to turn off the strat tester. I'm going to turn on the 1 minute time frame, and we are going to keep our close eye on what's going on with the Qs. Let's see. Ted, thank you, man. Glad, first time here. Glad you're hanging out with me, man. I appreciate it. That's awesome. Squeeze the cheese. We're about to find out whether we should be whether we should be long or short in this scenario. Looks like crypto's kind of moving. ETH at $1,500. Bitcoin 21.6. See, here we go. So what do we got? 75 bips. Do we know? Here's the hype. I'm going to pop over to Twitter real quick and see if we can find where we're at. What's the rate hike, fellas? What are they saying? Fellas and ladies, for any ladies in the house. Well, pretty boring move so far. What's up with the SPY here? SPY looks a little bit stronger than the Qs. 75 bips. Interesting. So there was an 81% chance that they were going to hike 100 bips. 81% was the last data value I saw. So 75 bips. Interesting. So what does that suggest then? Does that suggest that maybe they're thinking inflation is peaking? They don't need to be as aggressive? It's kind of maybe what I take from it. What about you guys? Yeah, wouldn't it be something if they just held it, didn't go anywhere? Shiv Kumar, what's up, man? Hope you're doing well. Congratulations on your big Tesla win. That was a great call. Shiv Kumar nailed the Tesla Open the day after earnings by like 40 cents. Yeah, so we got GDP too. I read somewhere GDP was negative 1.2%, but I don't know if that's if that was real or what that was. But I read somewhere negative 1.2 on GDP. When are the GDP numbers coming out? Do we know that for sure? Well, the market likes this 75 bips hike so far. Okay, GDP's out tomorrow. Good to know. Thank you, sir or ma'am. Tomorrow morning, got it. Yeah, I mean, this is kind of a relatively muted reaction. We're not getting much out of them here. Is SPY doing anything? Yeah, SPY's pretty chillin' too. What about IWM? I guess another thing that I'm kind of curious about is like, what are individual names doing? Whoa, Ethereum absolutely ripping. Look at this move. ETH is absolutely ripping. Shoo! Crypto is very pleased with the 75 bips rate hike. What about Bitcoin here? Bitcoin also quite pleased. Crypto across the board. Solana here. Big $2 move on Solana. Are the Qs starting to catch a bid now? Qs catching a bid. I had a level in mind that I was kind of watching. It was kind of right in here, that 305 area. Again, let's not forget, first move has a tendency to be wrong. Doesn't mean it's going to be wrong this time, but first move has a tendency to be wrong. That's the old adage. Estimate, Lloyd, thank you, sir, for that information. Estimate on GDP, negative 1.2 to negative 1.6%. If it's positive, it will likely ignite a rally, but there are 2 more revisions coming. What's up, Ren? How's it going? Man, ETH, so powerful. So powerful. Kind of crazy. Oops, wrong ticker. See if Ethereum has any levels. Yeah, I mean, it's coming up into that 1600 level. Definitely a level of interest. Do we have any crypto traders here? Any expectations on crypto from any of you guys? Man, thank you so much, everybody, for being here. We do really appreciate it. It's awesome to see so many folks tuning in, hanging out with us. If you're new to the stream, if you've never been here before, let me know. We do this a couple times a week, Mondays, Wednesdays, and Fridays. Today we're starting a little bit earlier than usual just because it's FOMC day. Why wouldn't we start a little earlier? QQQ pulling back a little bit here. Lots of volume on that previous candle. Akiva, you're new. Thanks for being here, Akiva. Appreciate that. How are you doing today? Hope you're well. Are you a TrendSpider user? What are we watching today, guys? Outside of FOMC and of course the indices, what else are we keeping our eyes on? I mean, we got Facebook earnings later on today. I'm probably going to hang out through Facebook earnings. Watch those. Akiva, if you scroll up, actually, let me hook you up real quick. If you're interested in checking the platform out, let me hook you up with this. Here is a link for you, sir. 25% discount. Joe Beltrami, what's up, man? First time here. Thank you for being here. And thank you to your buddy Chris Johnson for turning you on to the stream. Appreciate that. Yeah, Akiva, that's a 25% discount on any plan of your choice. Free 7-day trials. We can even do additional weeks on the trial. So if you're interested in the platform but you don't want to commit, that's totally fine. You can give it a trial. No, Joel, it does not. You can use that. You can store it away and use it whenever you feel like you're ready. Getting a little bit of a sell-off here. I'm going to anchor a VWAP onto today. Yep, and they are catching it right where you'd kind of expect them to, right at VWAP. Trying to fail it here. We'll see if it holds. This could be an interesting level for the day. We've got yesterday's VWAP hanging out at $298. Well, yeah, where's your green candle? I was promised green candles. You told me green candles, and I ain't seen them. Where they at? Where them green candles at? So then the question is, you guys, is the first move that bump, or is this the first move? Where does the first move actually start? I don't know. It's so hard to say, right? I think the first move is really just everything until Jerome starts talking. And then once Jerome starts talking, maybe we'll get some sort of something out of him. I'm really anxious to hear what he says. He's probably going to be elusive. He has a tendency to be relatively elusive. What do you guys think he's going to say? He's going to surprise in any way, shape, or form, or you think he's just going to give us the old Powell song and dance? I mean, if they're doing a 75 bips hike, then that kind of suggests that maybe they're thinking that inflation might be coming to a peak. Right? Is that what I'm supposed to glean from that? Is that what you guys are gleaning from that? Avishek, that's probably true. Avishek says he will probably say, or he will say future hikes will depend on condition of the economy and inflation. That's a pretty elusive answer, don't you think? Pretty elusive answer, if that's what he says. That kind of doesn't tell us anything. Just leaves us guessing. Ren E is 75 basis points neutral or a little bullish. Well, it just is not the max expectation, right? It's a quarter of a percentage point less than the max expectation, which was a full 100 points. However, it's still 0.75% increase. This means that homes just got more expensive. You know, everything just got more expensive. So that's not good, right? If you're trying to buy a house right now, that's not really what you want. Yeah, let's go back to the 5-minute. Yeah, so they held the VWAP. What does SDW say? Energy in July lower month over month than June, which leads one to suspect that inflation will come in lower in July versus June. Though that does not mean June was peak specifically. What's up, Ben Krupa? My boy who's not related to Gene Krupa. Glad you're here. Thanks for being here, man. Yeah, so then the question with energy, SDW, like I don't know if you were on the stream on Monday, but we were talking about the natural gas pipelines that Russia has, Nord Stream. Russia took down two of the pipelines, or something to do with the pipeline for the purpose of maintenance, allegedly. I don't know if that's absolutely true. We were speculating in here that that's not for maintenance at all, that they're just trying to squeeze Europe out of their natural gas. And, how then does that affect energy prices, even looking out, into the winter months when things might become quite a bit more difficult. If Europe is struggling to get natural gas from Russia, where are they going to get it from? Are they going to get it from us? Are we going to sell it to them? Are we going to raise our prices because we're limiting our supply? I don't really know. Canceled Keystone in Canada. Greenlit Nord Stream 2 from Russia, direct to Germany. What's up, Trader Dick? How we doing? Hope you're well today, sir. Inverse Walmart. Yeah. Oh, mortgage rates are based off the 10-year, not the Fed funds rate. Oh, okay. That's good to know. Thanks for the clarification, Aaron. I never claimed to be the smartest guy in the room. Just one of the guys in the room. Catching a little bit of a bid here off of that VWAP bounce on the Qs. I would imagine SPY's probably looking about the exact same. Definitely holding. Definitely made a new high on the day. That is a big indecision candle. It's all about Mr. Powell at this point. Interest rates, 1.25% hike. No. 0.75. 75 bips rate hike. Ramesh. Another thing to kind of be curious about is what have we done the past couple FOMC rate hikes? I believe, if memory serves, we could go back and look. If anybody's got the dates on the previous FOMC hikes. Sonic and Sega Fun Zone, you going wild. What are all these letters? But if memory serves, on past couple FOMC hikes had a really strong day of, and then it's faded, right? A couple days after. 22nd of June. Let's look and see kind of what happened then. I believe it's about here. Nope. Here? No. Where's 22nd? June 22nd. So here's your last Fed date. Looks like we gained for 2 days and then gave it all back. Or gained for 2 days, gave it back. Akiva. Hidden divergences. Where are you looking for them? Like, what are you using to spot them? Because there are a lot of different types of divergences. So if you can give me a little bit of specifics about what you're using, we could talk through how to go about finding them. We can use the scanner for it. I got my eye, by the way, y'all. I've got my eye on the Federal Reserve page here. So we're gonna get that press conference here soon. I'll pull it up on my screen as soon as it starts. Market might chill here until we get some words from Mr. Jerome. That would make a lot of sense, wouldn't it? All right, so you say you're using an indicator that lets you quickly scan various indicators at the same time and then charts the divergence. I'm told bullish hidden divergence on a bullish trend is a safer bet. I mean, that makes a lot of sense. What's the indicator? Or, okay, RSI and other stochastics focusing on. So are you comparing what's going on with RSI to what's going on with another indicator, or what's going on with RSI in comparison to price? I can give you like a very basic, show you what you would want to kind of think about doing on the platform. And then, you know, if it doesn't quite get you where you need to be, we could always kind of do a deeper dive later, or I could hook you up, or I could send over a calendar. You could schedule some time with one of our trainers. But essentially, the way that I think about divergence, and I'll just use very basic idea here, RSI and price. So a divergence, for anybody who's not aware, a divergence would be if RSI is increasing while price is decreasing, right? RSI making higher highs, price making lower highs, or something like that. So the way that we would do that is we would use the scanner to find any names that are meeting that criteria, or we could be alerted on that criteria. We could backtest that criteria. We're going to write a script in order to do this, though. And the way that we'll write that script in very, very basic terms is we'll say something like, I'm going to use the indicator option. We'll just use the daily time frame. I'll type in RSI. We're going to grab RSI here. And we'll say greater than indicator daily RSI. Right, so now we've got RSI on one candle is greater than RSI on another candle. We could define the candle that we're referring to by clicking where it says last here. When we click where it says last, it comes up with 0 candles ago. So last and 0 candles ago are the same thing. And they're referring to the current candle. So if we want to say RSI on the current candle is greater than RSI, maybe like, I don't know, 10 candles ago or something like that. We could do that. And you could stack this if you wanted to. So you could say something like RSI greater than indicator daily RSI. And you could say RSI 10 candles ago is greater than RSI 20 candles ago, right? So you've got increasing RSI, right? The RSI in the current candle is greater than 10 candles ago. RSI 10 candles ago greater than 20 candles ago. This is just some random numbers that I'm choosing here. You can use whatever you want. At the same time, we want to be defining price during this period, right? We want to specifically say that price is not making higher highs while our RSI is. So what we would do is we would say condition, we'll say price, I'll say daily high is less than price daily high 10 candles ago, right? And I could do it again. I could stack it, say price daily high less than price daily high. Make this 10 candles ago, make this one 20 candles ago. So now while RSI is increasing, we've got the highs, lower highs being made, or at the very least, not higher highs being made. So this would be a divergence, right? You could do the same sort of thing with multiple indicators if you wanted to. It really comes down to like the specifics of the candles that you're referring to, right? These are very specific candles. We're saying specifically 10 candles ago, specifically 20 candles ago, right? So you gotta think about that a little bit. But this is how I would go about spotting divergence on the platform. This is how I'd go about searching for it. As far as this divergence for many indicators, the volume 4.0, this is not something, or that's not something that's on the platform. It may be something that we get in the future, we add to the platform in the future. I can't say for sure if that's something that we'll add, but this is how I would be thinking about Akiva. This is how I would be thinking about looking for divergence, and then it's really just a matter of being kind of specific. Getting specific with the indicators that you're using, getting specific with the time frames that you're using. You know, in this particular case, I used very specific prices. We could use range. We could say, you know, the high today is less than the range high X candles ago, so that you're not pinpointing exact candles. You're just pinpointing ranges of candles. But again, we're starting to get into like, I need to know a little bit more about the specifics of what you're looking to do. And that's where really signing up for a one-on-one training session with one of our educators would probably be your best bet, just because we could talk one-on-one and you could ask specific questions and they could walk you through it. So for everybody who's watching, who's maybe a TrendSpider user and might be interested in one of those sorts of training sessions, you can sign up for that by clicking on your name, top right corner, scroll down to where it says schedule training. It'll be kind of right around in here. I don't have that option, obviously, because I'm an employee, and I was a trainer for a year and a half. So I don't have that option, but you'll see it, and then just click on it. It'll send you to a link to a calendar, and then you can just sign up. Yeah, so we are a no-code platform, Akiva. PineScript I believe, is unique to TradingView. I don't know that for sure, but PineScript is a unique language, maybe. Again, I'm not. This is a little outside of my wheelhouse, like coding. I don't really know too much about coding myself. I really don't know anything about coding. We are a no-code platform, so you do not need to know code. You just need to understand the logic behind how I'm coding all this. So you saw how I did that, right? I never had to input any weird coding anything. I just inputted the very basic of what I was looking for. An RSI condition, or rather an indicator condition, or a price condition, or a candlestick pattern condition. And then you just have to define conditions. We are going to add custom scripting in the future. And when that comes, I'm not sure the language that we're going to be using. I can't speak to it just yet because I don't know. But for now, all of the coding or all of the scripting on the platform is just logic based. There is no code per se. And so essentially what you can do is I wrote this script. We'll call this a script. I wrote this script here in the scanner. Well, this script can be used in the multi-factor alerts. It can be used in the back tester. And the way that you would utilize it in those other tools is you just would click on script actions here and you'd say save as template. So we'll just call this like a Kiva template, right? We'll say save. We see that it's written over here. So now we know it's saved as a script. And if I wanted to, like, let's say I wanted to get an alert when the Qs meet this criteria, I can come up to my alerts widget here, or my alerts button, click on multi-factor alert, click on script actions, load from template, and say Akiva. So here's those conditions again. Say choose this script. I choose how long I want it to live in my system, how many times I want it to trigger, and then Akiva hidden divergence, right? Right, this is just a title. Say create alert, and now I'll be alerted on the Qs when that criteria is met. Super, super simple. Same deal for the strategy tester. If I want to use that criteria that we just put together as entry or exit criteria for the strategy tester, I would just go to script actions, load from template, go to Akiva, right? And so now those conditions are my entry criteria on my strategy tester. So once you write it once, as long as you save it as a script, you write it one time, you can use it everywhere else. Super, super functional, super easy. But I also do know that a lot of folks, a lot of users do have issues, or, you know, they struggle with how to go about writing these. Maybe it's because they don't know exactly what to be looking for. Or maybe it's they just simply don't know how to really utilize the scripting language. Or just how to write these things out. They know what they're looking for. They don't know how to write it out. We are happy to help with all that stuff. So you can always reach out to us, either in chat via the contact us button down here in the bottom right-hand corner, and ask us questions. Say, hey, I want to make a scanner for a MACD cross on volume where, you know, the stock is put in 3 green days, but you don't know how to do it. We could help you write that. So we got a team on hand that just answers those sorts of questions all day. So hopefully that's a very long-winded answer, Akiva. I hope that helped. If that doesn't quite get you there, though, feel free to hit me up on Twitter at Krutzky Trades, and I'm happy to assist you further. And I could connect you with connect you with one of our trainers. Ramesh, we got it, man. It's 0.75 bips. 0.75%, 75 bips rate hike. Now we're waiting for the press conference, which should start any minute. I am monitoring it over here, and as soon as it comes on, we will put it on the stream for you guys. The move in crypto is very interesting to me, because there's been a lot of talk lately about crypto not being an inflation hedge. But if 75 bips is suggesting maybe that inflation, maybe the market is thinking that they're not attacking things as succinctly or as powerfully as they should with a 75 bips rate hike, then maybe the narrative around crypto not being an inflation hedge, I mean, the price of crypto is increasing and increased. ETH is up 7.5% today. Maybe that narrative is kind of under the hood is changing. Be curious to know if you guys think something like that as well. Got a meeting at 2:30. I'm going to pop this over here. So we got it on the main screen. We will definitely get audio to it here as well. Go to SPY. Just check out what's going on while we wait. Ah, here we go. All right, let me do this. me 1 second, you guys. Turn this music off. Turn this music up. We're not getting any audio just yet. Let's see if we can get some. Actually, there he is. Here we go.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet.
Are they, though?
And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
Here we go.
Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%.
Q's losing their bid a little bit.
Food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from
Does that help
Russia's
you
war
guys on the
Ukraine
volume?
has boosted prices for gasoline and food, creating additional upward pressure on inflation.
Let me know if the volume's still too low.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
Great. Sorry about that, guys.
We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective.
We got a ways to go.
At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 2.25% to 2.5%.
Awesome.
And we're
Thanks,
continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for
SPY's gaining
compelling
again.
evidence that inflation is moving down, consistent with inflation returning to 2%.
Q's gaining again.
We anticipate
Trying
that
to anyway.
ongoing increases in the target range for the federal funds
There
rate
they
will
go.
be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase is in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting,
Quite a bit of volume coming in
that
here.
is a
on
decision
the
that will
indices.
depend on the data we get
Q's
between
starting to
now
go.
and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
Slow the pace of increases.
Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at?
Q's moving.
We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need?
SPY as well.
There's some evidence that we are.
Market likes this.
Of course, we'll be looking at labor
far, anyway.
market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see. And we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that in it's going to evolve. It's obviously, it has evolved over the course, I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina.
Hi, Jarrell. Thanks for taking our question. Gina Smile with New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level, ultimately, at which we are
have a good day.
confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have 2 questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions. And those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy. Thanks.
So we're going to be focused on getting inflation back down. And we, as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that. But that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do. And we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the
How are you guys feeling about this so far?
Outweigh
What do you guys think
the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, you know, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions, when that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking,
How are you guys feeling about this so far?
do you believe the United States is currently in a recession? Will the GDP
Wanna hear
reading
from you
tomorrow
guys.
affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular.
About time for what, James?
As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now.
Got it.
Haven't
Fiscally
seen it,
responsible
and
decisions.
we'll just have to see what it says. I don't.
What's up,
I
David?
mean, I would say generally the GDP numbers
SPY
do
broke
have a
weekly
tendency
high.
to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into
Ooh,
that.
it
But
did.
You tend to take first GDP
Q's
reports, I think, with
not the same
with a grain
scenario
of salt.
yet.
But of course, it's something we'll be looking at.
Hi, Chair Powell. Victoria Guida with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
SPY
those
so
are the
strong.
toughest rules in place, at any comparable institution that
Coming
I'm aware
into
of.
that
think,
gap fill.
We thought about this carefully, and
Gap fill at
we put it in place, and we're building the
401.30,
infrastructure
401.40.
so that
They're going for it.
the enforcement will be tight. That actually you won't be able to make trades unless they're pre-cleared, and the amount of trades you make will be they'll have to be 45 days or more before any FOMC meeting. It's just I think we've really created a very strong
I could do that, Lloyd.
set of rules.
I just wanted to make sure
that
you guys were
will,
watching.
Support public trust in the institution. And
There we go.
again, we're just now, the system is just now up and running, and I'm proud of what we did.
Yeah, so here's what we're looking at.
Hi.
401.44 for that
Bloomberg
gap
News.
fill on SPY.
I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for, making the decision on
Was
how
last
much
week's high in Qs
to raise rates?
308.55.
And, just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead
Kind of
you
a
to
relatively
slow
logical
your
place to
hiking
pause on
pace?
Qs. Come
So-
in here.
I'm gonna take that as a question about the next meeting and thereafter. So, as I mentioned, we're gonna be looking at all of those things: activity, labor market, inflation, and we're gonna be thinking about our
Crypto's
policy
still
stance
gaining.
and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the
this
process goes
volume
on,
on
at
ETH.
some point, it will be appropriate to
Bitcoin.
slow down.
Yeah,
And we
Bitcoin.
haven't made a decision when that point is, but intuitively that makes sense, right? We've been front-end loading these very large rate increases. Now we're getting closer to where we need to be. So that's how we're thinking about it. And in terms of September, we're gonna watch the data and the evolving outlook very carefully and factor in everything and make a decision in September about what to do. And I'm not really gonna provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made.
Are they setting us up for that? An
We are,
unusually
we're going to
large
be
rate
guided by the
increase?
data. And I
They
think you can
might
still
do
think
another
of the-
unusually large rate
the
increase?
destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Hi, thank you. Chris
Absolutely,
Rugaber,
Alan.
Associated Press.
That's what we're here for, man.
I wanted to ask about, right now, there's a sort of growing gap between the Fed's preferred measure of inflation,
So let's see
the
it. Let's
PCE,
try something
PCE index, and the one that's followed by the public. The
I guess I should have just
CPI,
done
of
this
course.
from the get-go, huh?
How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI
I should have
readings?
done that from the get-go.
Thank you.
I'm sorry, guys.
So it's an interesting situation. Of course, we've
no.
we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The
James,
typical
man,
gap
I've
was
been
really
chilling
about
all
25
day.
basis
I have
points
not
for
traded a
very long
thing.
time. And if it got to 40 basis
What's the
points,
point?
that would be very noticeable. Now it's much larger than that because of
I have
the
no
things that
opinion
I
about
mentioned.
what's happening right now.
So we'll be watching both, but again, the one
So
that
it
we
didn't
think
seem
is
like a
the
good
best
idea.
measure always has been PCE, at least since I think we.
What about you?
20 plus years ago, moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end-of-the-year target, but where are you in the journey? We've now seen
Exactly.
the federal stimulus programs end. You mentioned consumer spending, business investment have slowed. Are they moving at a pace you would expect, or is demand still greater than
Which ones?
supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023. when the economy might be weak. How do you know where you are and where you
Talent
think,
EDU.
you need to
We'll
get
look at
to?
those as soon as the
Well, just talking about demand for a
as soon as
second.
this FOMC is
As I
over.
mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think, people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter. But at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong and the economy has gone right through that and been fine. So that's happened many times. And it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative and the labor market was moving along just fine, and it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Nicole. Hi, thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already seeing, you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation. Still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say and also anecdotally, you hear much, the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. But it's only the beginning of an adjustment. But I think most also, if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So
Lloyd, what do we think?
executive
Are they going to
summary,
hold
I
it?
would say
Keep gaining? Are they going to
there's
fail
some
it?
evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment.
How much weakness would you be willing to accept before you think about pausing rate cuts?
So I think we're going to be looking at inflation as well. We as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. And
Q's, High-a-day.
We do think, though, that the labor market can adjust because of
High-a-day.
the huge overhang of job openings. of excess demand, really. There should be able to
IWM?
be an adjustment that would have lower than,
High a day?
perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding a recession. So how close are we to a recession? And then how do forecasts of possible recessions from banks and economists, how does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. And I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was a lot?
Forecasts.
On track to grow this year.
Recessions, economies, does that affect the soft landing?
Well, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event, given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand that you could see that demand coming down in a way that didn't translate into a big increase in unemployment, as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertainty. And so I would certainly say it's an uncertain thing. Nonetheless, it's our goal to achieve it, and we'll keep trying to do that.
Thank you, Mr. Chairman. Jean Young with Market News. I wanted to ask about the balance sheet reduction program. It's been working for a couple months now, and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. And I guess your second question was getting, the process of getting back down to the new equilibrium will take a while, and that time, it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late, with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still. Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break-evens coming down, which is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we'd like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy, and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Thank you, Chair Powell. Greg Robb from MarketWatch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So, yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we'd rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that has materially changed the situation. But I have to admit, I don't think I would do that again. I don't think I would do that again. Ultimately, the situation evolved in a highly unexpected way for all of us. And, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly different in the United States, but anyway.
Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all those? Thank you.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, in both 13 and 18, really had consequences for the real economy 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time. And so, that's really what accounts for the pace at which we moved. And we did when inflation changed direction really in October. We've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month, and we kind of thought we had the story, probably had the story right. But then I think in October you started to see a range of data that said, no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted, and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the U.S. in a recession? And just remind us, what is your definition?
That's a big question.
For the start of a recession?
So the Fed doesn't make a judgment on that. We're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession, that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, if you think about what a recession really is, it's a broad-based decline across many industries that that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a strong signal of economic strength that it makes you really question the GDP data. But
meanwhile,
again,
tons of tech companies laying off 10, 20% of their sales forces.
Thank you very much. Simon Rubinovich with The Economist. You've said that some
Wonder if
softening
he
in the labor market
hasn't
is
heard about
needed. Within the Fed, there are staff economists who've argued that NIRU, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of NIRU? Is that something that came up in discussion with the committee?
So I think broadly, a lot of economists think that the natural rate of unemployment will have moved up to some significant extent above where we think it was before. And the reason is it's the usual matching issue where matching has become less effective and that kind of thing when you have
trying to make a new high here.
Turbulent downturn and the big switches in demand from services
there
to
it goes. SPY new
goods
highs
and all that. So it could be higher.
Q's probably coming
my own
shortly.
instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is as all these jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off of inflation, because it's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for, the negative slack we have in the economy by the overtight labor market. So if you were to, you wouldn't observe this. It's an unobservable, but you could actually be seeing inflationary pressures coming down if that does happen. And we don't control that, but that's something that logically, if the pandemic and the disorder in the labor market cause the natural rate to move up, then as the labor market settles down, in principle, you should see it move back down.
Man, they held today's VWAP perfectly. Look at that.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or heading for one. Economists pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession or we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to a potential downturn in the economy?
3 cents from a gap fill.
All I've really said is I don't think it's likely that the U.S. economy is in a recession now. And I've explained why that is the case. It's because you do see a very strong labor market, and I think the public will see that as well. going forward,
That's a logical place to take a short.
what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also
Not saying
said
you should.
that,
Just saying.
Our goal is
Nice
to bring
reaction
inflation
there, though.
down and have a so-called soft landing,
Let's
by which
dollar
I mean
move.
A landing that doesn't require a significant increase, a really significant increase in
In 2
unemployment.
minutes.
We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging, and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so
This
far
meeting
this
is
year.
serious.
How concerned are you
I feel like
that
it's
the
longer than
rate hikes,
usual.
that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
I mean, there are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So
What's China doing
we've been known to
here?
do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that that basically markets have been working, they've been orderly.
James, we're
There's
gonna
been some
take a look at,
volatility, but that's only to
your-
be expected. For a financial stability
your
perspective,
China education names here.
asset values are down, which in some sense lowers vulnerabilities.
That's a heck of a
It's
base.
when they're really high that you would worry that they're vulnerable to a fall. Actually,
Finally,
many
seeing some
asset
closes above
values
that
have
angered
come
VWAP.
down. I think you've got a well-capitalized banking system. I think you have households are
Same look, huh?
generally in
EDU
about
looks
as
a little
strong
bit better,
financial
making
shape
new
as,
highs.
as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets, and so you have a pretty, from a financial stability standpoint, you have a pretty
Making
decent
new highs
picture.
too, really. I mean,
now
against this
macroeconomic, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability,
Gap
we think
filled
of
on
that
SPY.
as things that might undermine the working of the financial system. So big,
There you
serious
go.
things. That's not to say that people at the lower end of the income
Now what?
spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to the grocery store and finding that in many cases their paycheck, it doesn't cover the food they're
Q's
accustomed
new
to.
high on
We're
the
seeing
day.
actual, real declines in food consumption, and it's very concerning. It's very unfortunate, and that's why we're really committed to bringing down inflation. One of the reasons.
Go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. I can remember when you held your first news conference and you vowed to be a very plain-spoken chairman, and we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape?
Yeah.
Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job, it is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people, and we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth to slow to below potential growth. We don't.
Soft fun, we don't know, man.
Want to, we don't want this to be bigger than it needs to be.
It's gaining it right now.
Ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market.
Just because it fills
and
does
wages
not
that
mean
aren't
that
being
price should
eaten
sell
up
off.
by
You
high
got an
inflation.
initial
If you
reaction
talk
there?
to people again, people who are making, wages, relatively low wages.
Quick little move, but it's gaining.
They're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
That's that, guys. Well, there you go. Let me get some music going here real quick. Switch this back. This might be real loud. I apologize. We're quite lower here. All right, everybody. So there you have it. There's our FOMC meeting. What are we thinking? How are we feeling? Do we like it? Do we not like it? Is it about what we expected? The market seems to like it. Q's new high of day. Q's coming back into that anchored VWAP from those March highs. That is a level of interest for us. Definitely want to see it gain that if you are bullish. We are above the 8, 21, 34, and 55 daily EMAs, David says. Let's add a few of those. David loves his EMAs. Let's add them. What is it? 8, 21, 34, 55. Yes, sir. Quite above all of them, aren't we? If you're following EMAs, this ain't bearish, is it? Yeah, SPY to 420.69. A nice meme number. Certainly could happen. Where have we seen this happen before? Last time we were above all of those EMAs, David. Right here. On March 18th. Did anything significant happen on March 18th? Does anybody know? Kind of curious to know that. We ended up rallying after March 18th when that happened. I guess technically we did close over them here on the 21st, but we rejected immediately. SPY's loving this, though. Market's loving it. Ethereum back to 16 hundo. Ethereum up 10.5% on the day. Solana up 10% on the day. Really nice move there. The market is pleased. Jerome threw his offering into the volcano. It must have been a good offering, because the market is pleased. You say 420. Joe Nobody says 420.69 for SPY. I mean, not impossible. Where is that? Thereabouts. If we look at the Qs relative to, Qs are trying to get there as well. Like the Qs relative version of that would be somewhere about here, right? 316 or so. Past couple FOMCs, real strong move day of, and we gave it back within a couple of days. Will we continue that trend? We've got 30 minutes until earnings here. And I'm pretty sure that Facebook reports this evening. Oh no, they're Meta now. We've got Facebook earnings at the bell, after the bell. Anybody want to take some guesses on where Facebook's going to open tomorrow? If you're interested in guessing where Facebook's going to open tomorrow, hit me up. I never use Facebook. I haven't been on Facebook in years. Do you guys use Facebook? I don't. I cannot be a judge here. James says 137. Safwan, Apple earnings. Ooh, Apple earnings after the bell today? Or no, I believe they're tomorrow. Yeah, they're tomorrow. Apple looking very strong today. Apple earnings could be very interesting and affect markets tomorrow for sure. I wonder if we have any stratters taking profits right now on Apple, gaining this high right here. Maybe they took profits on Apple gaining this high. Amazon. I believe Amazon's tomorrow too. Yeah, Amazon's tomorrow, sir. Any other guesses on Meta? Shiv Kumar. What you think, buddy? Are you still around? He had the golden touch with Tesla. James, I'm going to counter trade you here, sir. I'm going to say we're going to close 175.60. That's my guess for tomorrow. Or rather, I'm sorry, open. Open. We're looking for the open. Here, where did my thing go? Did I put you on the weekly? Maybe I did. Yeah, that's what I did. Oops, 175.60. Isn't that what I said? Well, James, you can't do that. You gotta. Is that your real guess? 160 is your real guess? We'll change it. I'll give it to you. If anybody wants to guess, you got 27 minutes. Joe Nobody says 133. Aaron, that's interesting. Up because it already took a hit from Snap. Yeah, possible. Question, I mean, I don't know, but I'm kind of curious about like usership of Facebook versus Snap. I mean, all the kids are on TikTok now. Are they even using Snap anymore? I feel like TikTok's just running away with the game across the board. Caleb Campbell, 11% down. Okay. What does that get us? I'm just going to guess for you because you're not giving me an exact number. 150.67 for Caleb. Anybody know what time they report? Do they report like right after the close? Yeah, man. I mean, TikTok is stupidly popular. Stupidly. It's not stupid because it's entertaining, but it is crazy how popular it is. Xander, we're talking about meta here. We're not talking about SPY. Sorry, man, but that's how we're doing it. We're talking about SPY. Take a look at meta. Let me know. Chris, I don't know. That's a good question. See if there's any news about that. We check and see also. Excuse me, guys. What's going on with unusual options? I'll check that here soon. I'm not seeing anything in the news about that, so I don't know. On the unusual options side, let's see if anything interesting has come in here. $222 calls in March 2023. The reason why this is interesting to me is the open interest, 323% of the open interest. This came in today, an $86,000 premium. $152.5 puts for looks like Friday expiry, 50% of the open interest, a $250,000 trade. Interesting. 152 Ps there. The 120p for June 2024, 208% of the open interest. Only a $40,000 trade though. I'm always interested in these big open interest plays. It's kind of interesting right here. The 182.5 call. August 19 expiry. 221% of the open interest. $480,000 in premium. That's a big bet. Or maybe it's a small bet for a big player. 1.9 mil here. No, 1.6 mil, sorry. On the 160 call for December expiry, 61.65% of the open interest. $1.6 million bet. It's a big one. I say bet. Maybe this isn't a bet for them. Maybe they know something we don't know. Any other guesses on Meta? You have 22 minutes to get your guesses in on Meta. Where does it open tomorrow morning? Qs. Getting a little bit of pullback here. If you're long, doesn't seem like anything to really be too worried about. SPY as well. Energy. Trying to make a new high. Against the high that we put in on the 26th. I believe that was a Monday. It was the Monday opening. No, yesterday opening. Sorry. I'm losing track of my days. Safwan says 155 for Meta. Let's add Safwan's guess to the list. Me over here, Mr. Big Bull. $1.02 billion for the Mega Millions jackpot. What are the odds of winning that, Joe? Just got an alert triggered on STNG. This is a short opportunity play that I've been looking at. I love that it gained this high here. I know my man David Yoakum over here. David Yoakum, big bull on STNG. $300,000 to 1 seems low. I bet it's more like 300 million to 1. STNG earnings today, tomorrow. Show you why I'm kind of interested in this STNG short. This was one of the initial reasons. Here's your AR. Came in, took out those old highs from that previous pivot a long time ago, 2015. There were a couple other plays that I had found that were very similar to this. Coming into like a long ago high. Let me see if I can find them. I believe ELF was one. No, ELF was just a new all-time high. I can't remember what they were. But I've kind of been waiting for this moment for a bit now. James, I know STNG's been in the Bury port. I think you mentioned that to me. Since 2020. Well, if it's been in the port since 2020, he's back to break even now. So congratulations, Mr. Bury. You did it. You made it. Well, actually, okay, never mind. January 2020 highs. Depends on when he bought. If he bought anytime after January, then he's finally in the money again. But if he was buying in 2020, I mean, he had to sit on this trade for a long time. I would expect some profit taking here. But, you know, who knows? I could be totally wrong. Earnings tomorrow. So definitely something to be mindful of. Earnings tomorrow. Chris L. Let me add you to the meta list. Chris L says 162.2. I put these in order from the start here because it took me forever to put them in order last time. There we go. Anybody who wants to be a part of this, hit me up. It's a $2 investment, Joe. Yeah, it is. I don't know if it's an investment. It's a $2 gamble. Do I want to spend the $2 on a cup of coffee? Or do I want to spend it on a Mega Millions lottery ticket? I don't know. He bought quarter 1 2021 and sold out quarter 3. All right. Well, there you go. Q's making a new high against last week's high. Right here. Oh, no, they didn't. No, they didn't. No, they didn't. Q's trying to fake us out a little bit. I believe SPY did, though. David, you said that SPY did, right? Yeah, it sure did. What about IWM? IWM did as well. Kind of got to assume that Q's will. I mean, you don't have to assume. It's not good to assume. You know what they say about assuming. We got Apple earnings tomorrow. We got Amazon earnings tomorrow. We got Facebook earnings. Some big earnings results coming up. What about Apple? Let's see. Actually, let's do this first. I want to see if anything came in here. On the unusual option side for the Qs. 302 puts for Friday expiry. $173,000 play. 44% of the open interest. This came in 5 minutes ago. Right off of those highs. This person could be cashing out of those right now, making quite a bit of money here. A quick 5 to 7% on a $173,000 bet. I take it. Don't know about y'all. 15 minutes. Facebook earnings. Get your votes in if you got them. Interesting, Sadie. Your mom visited last week. It was the most you'd ever seen anybody on Snap in years. The concern there for me is it's your mom. Now, if it were your young cousin, your 13-year-old cousin, then that would be interesting. But it's your mom. Parents are always late. And if parents are there, why kids aren't going to be there? If parents are there, it's over. It's just like with Facebook. When your parents showed up, you got off Facebook. Right? Didn't we all do that? We all got off of Facebook when our parents showed up. Yeah, see? Sadie knows. For everybody who is tuned in and made it this far, man, I really appreciate y'all being here. It was fun hanging out with you guys. As my way of saying thank you very much. If you are not a TrendSpider user and you would like to be, or you're considering, here's you a 25% discount. $25% discount for anybody who's not a TrendSpider user currently. Help yourself to it. Sign up for an account. You can use that on any plan, monthly or yearly. There was somebody who was asking about Discord earlier. I don't know if you're still here. If you are curious about the TrendSpider Discord channel, hit me up privately on Twitter at Krutzky Trades, and maybe I'll send you a link to it. What do we think about the action today? Do we think that markets are going to continue gaining into the rest of the week? I know that it's all about the numbers tomorrow, GDP. But we already kind of know what the deal is there. They've already kind of suggested it, right? Negative 1.2 to negative 1.6. What was it last quarter? Negative 1.6, I think. PCs on Friday. Personal Consumption Expenditures Price Index. So much data this week. It's crazy. This is why everybody was taking the week off. Too much data. Maybe they just don't do anything. Maybe they just flag it out, go sideways for a couple of days, go inside, kind of like they did over here. Or kind of like they did here. Or kind of like they did here. I have no idea what they're going to do. No clue. No expectation. Anything you guys want to look at? 10 minutes left. Anything anybody wants to look at before we get up out of here? My STNG idea. I'm going to let earnings play out and see what happens on that one. David Yoakum, my friend. You too, sir. Let's take a look at some of these guys. Walmart got rocked. Yesterday. Or no. Yeah, what was that? Let's see, actually. Let's go to the daily here. I know Walmart got rocked, but when did they get rocked? Yeah, yesterday. No. Yeah, yesterday. So given, I mean, dang, they're going back for that gap, aren't they? Go to a different time frame here. It's a little bit of a different reaction than the last earnings, huh? Your last earnings, you gapped down. You just kept gapping. Crazy. They held a higher low. Or they at least held the low. So that is a check in the positive column. Coming into kind of where you broke out of, kind of in here. Right? Kind of flat top, little breakout. I mean, there was a little breakout here as well. You have these previous highs. Yeah, I don't know. They could come back into the gap. They could come back to this kind of this fair value gap area right here, 122.5. I anchor a view app and kind of see. Is there a little gap here? No, that kind of looks like one though. Let's anchor from here. So we're above the anchored view app from last earnings date's gap down. So that's good. You know, you always want to see price above the major anchored view apps. Let's go to a daily, see where we're at. I'll throw up some of David's EMAs here. Below most of them. Below all of them. Not great. Lots of buy ratings came in. Reiterations of buy ratings came in off of that very, very lousy earnings report on Walmart there. Also got a lot of them last quarter too. It's kind of interesting. Costco coming into the gap. Almost filled it today. Looks like I had a level marked around the 503 area. Kind of the, again, same idea, that breakout, come back, retest. I'd be more interested in a short opportunity personally on Costco. Don't really have an idea on it though. TGT. TGT, whoa. I haven't looked at this in a long time. Yeah, I wouldn't touch this personally. It's a big range, but you're stuck in it. 135 to 165. Probably have to wait for earnings, would be my expectation on it. I'd wait for earnings, let earnings do their thing. On the, let me go to a bigger time frame. It is kind of interesting. Another kind of fair value gap. If you're a strat trader, our strat traders are interested in these fair value gaps. There's definitely one right here. And where did we come right back to? Came right back to it. That's kind of interesting. Another down here around $100. Psychological level. Definitely a lot of retracement upside potential on target, but I would just wait for earnings personally. Xander, I am not a long-term guy. I've never held anything more than like a week and a half. Pepsi looks kind of interesting here. I mean, only thing is concerning, you've got lower highs. I mean, you could be in this. This could take a long time to play out. Yeah, Pepsi doesn't look terrible. Getting into the top of the range. Definitely want to see 173. That you want to see them gain the high here. And then you might can target these next highs. 176. Not much there. Not much meat on the bone. I don't know. With only $4 between, or well, $5 between, are these all-time highs? Yeah. I would wait and let them make a new all-time high. There's just not much meat there. If I were trying to go long, see if they gain it, come back, retest. Tricky because you're making higher lows, but you've made some lower highs here over the past couple of months. I mean, past couple of days, they're trying to break out of the flag for sure, but you've got these highs. You've got a couple of highs still to contend with. This one and this one right here. Just looks like a really slow mover. I've never traded Pepsi. Look at Coke. Kind of the same look, huh? And did they have earnings recently? Yeah, they had earnings yesterday. Let me go to the weekly. Actually, let me go to the monthly. Yeah, so this isn't so bad. I should probably look at the monthly on Pepsi. But I kind of like this. I mean, you know, what'd you do? You had your old highs here. You gained them. You've back tested now a couple of times and made some higher lows. I like that. Next step will be a move above this high, all-time highs. You've gone 2 up on the week, huh? Right here. Took out previous week's high. But you failed it. You've lost it. But I believe the way that a 2 up works, because you went 2 down, 2 up, that's like a reversal pattern. I believe your target is this high and then this high. So 66 and then 67. Again, slow mover, man. I mean, that's 5%. Let's just see what the story is here. Yeah, I think KO does look a little bit better personally than Pepsi. Xander. Let me go back to Pepsi and look at that monthly though. All right. Actually, wow. Dang, Pepsi so strong. I mean, long term, so strong. Let's go to Meta. The bell has rung. The time has come. What are they going to give us? We're going to watch this for just a few minutes, see if we can get the initial reaction, and then I'm going to jump out of here. Any last minute guesses before this train takes off? We're looking for the opening price tomorrow. Just for bragging rights. Q sold off a little bit into the end of the day, huh? Q's up 4% on the day, though. Wow. Crypto remaining strong. Does anybody know what time Meta reports? Let me see if I can figure it out for us. Qualcomm. This was one of David Yoakum's ideas from yesterday's Trade Ideas Space. Qualcomm sees 4-quarter revs 11 billion to 11.8 billion, estimated 11.92. Qualcomm drops 3.3%. Let's check that out. Qualcomm. Ooh. Some buyback going on there, though. Back to Meta here. Still nothing from Meta. When are they going to give it to us? We want the earnings. Give us the earnings. Zuckerberg, get off your surfboard and give us the earnings. Tired of waiting around. What is Mark Zuckerberg doing right now? Very curious to know what Mark Zuckerberg is doing right now. Probably not watching Meta earnings. Still nothing. Anybody know what time Meta reports? It's supposed to be after the bell. furthered by rumors of a potential revenue decline for the first time in the company's existence. Huh. Interesting. Yeah, ooh. Oh. Oh. Ouch. Yikes. Look at that move. Holy guacamole. It's just the first minute. We could come back. Don't look good though, does it? Maybe they're just trying to scare everybody. I've got targets to hit, baby. All right, we need some numbers here. Let's see if I can find them. Meta earnings revenue 28.8 billion versus 28.7 billion expected. EPS 246 versus 251 expected. So revs down by 0.1 billion. No, revs up. I'm sorry, revs up by 0.1 billion. 100 million. And EPS miss by 6 cents. I'm seeing lots of different information here, though. Like one guy's saying EPS estimate was 314. I don't know if that's true. Yeah, a couple of people saying a couple different things here. But earnings missed. Revs look like they missed, actually. Yikes. How is it affecting the Qs? Is it affecting the Qs? Yes, it is. Youch. Well, if you went long into the Qs at 308, I hope that you got out of that position quickly. Wow. Q's getting rocked here off meta earnings. Holy guacamole. $160. I mean, it's really not even that big of a move. It's $10. Talking about 5%, maybe a little bit more than 5%. We'll see. It's a long night. It's going to be a long night, potentially, for meta longs. There's a big, big area. Really needs to hold this 160 level. Qs are feeling it, though. Qs are feeling it. Well, guys, that's it for me. It has been more than a pleasure. It's been an honor to hang out with all of y'all today. I do mean that truly, genuinely. I appreciate you guys spending your time, your afternoon with me. Could have been anywhere, but you were here with me and with us here at TrendSpider. So I have to say thank you so much for that. It means a lot, truly. I'm going to be back on Friday morning. That's going to be 10 p.m. Eastern time. Be a quick little session, 10 to 11:30, 10 to 12, something like that Eastern. If you guys want to come hang out with me, let's come hang. We're going to be talking everything that's happened in the past day and a half, right? We'll be talking about GDP. We'll be talking about Apple. We'll be talking about Amazon earnings. I'm just reading through y'all's comments real quick. Ford got a beat. Xander, you didn't take the meta puts. Too bad, man. Too bad. Duane, what's up, Duane? Good to see you, buddy. You got here a little late because I'm just about to leave. But yes, so I'll be back here on Friday morning, 10 p.m. Eastern. However, I'm going to be also back here on YouTube tomorrow night. I'm going to be hanging out with Jake Wujastic, the man, the myth, the legend. You guys know him. Everybody loves him. He's a great guy. If you follow him, he's got a cute kid. He always posts pictures of his cute kid. I can't wait to hang out with Jake. He and I are going to be talking shop, talking markets tomorrow here on TrendSpider TV on YouTube. We're going to be doing that 8 p.m. Eastern time. And we're going to be taking your chart requests. So come with whatever charts you want Jake to chart for you. And we will be happy to chart those things for you. We'll be here for about an hour. 8 p.m. Eastern time. Live charting with Mr. Jake Wujastic. So come join us for that. I'm going to sign out. Again, thank you all for being here. I do really appreciate it. Joe, Dwayne, Chris, Dawson, Xander, Caleb, who else? Lloyd, David Yoakum, James, who else? Safwan, Aaron, who else? That's the Alan Moreno. Yeah, I really, again, Roman, Gordon, Trader Dick, I really do appreciate all y'all being here, hanging out with me today. And I look forward to hanging out with you again tomorrow, or Friday, or next Monday, or next Wednesday, or next Thursday, or next Friday. I'm going to be around. So holler at me if you need anything. I'm on Twitter, at Krutzky Trades. It's at the bottom of the screen. Let's see if I can do this correctly. It's like, nope, it's there. It's right there. Or it's right over there. Yep. See how good I am at this? Hit me up if you have any questions about TrendSpider. Take advantage of that 25% discount code that I've been linking. Somebody asked if it was good forever. It's not. It's good for 5 days. So if you're interested in it, I was wrong about that. I just found out. Take advantage of that. And yeah, I'm actually gonna get out of here now. Have a great rest of your day. Happy trading, and we will catch you all next time. Bye.